Thank you and good afternoon, one and all. Welcome to the second technical session of the International Conference on which is accounting norms and basically forensic accounting. But today, the caption which is assigned to me, or the theme which is assigned to me, is on IFRS and the Indian accounting standards. So this is highly conceptual, but rather than confining to the mere concepts, which I think is part of information, which by and large all of you would be knowing, I would be focusing a bit on perspectives of, as well as discussing a bit on the disruptiveness which is actually taking over into accounting, which is, I would say, partially being addressed by the convergence of accounting standards. So this is what we actually intend to cover. Now, already in the first technical session, we were discussing at length statements and reports, how much of analytics is possible through that, and what exactly, or more so, in preventing misuse or seeing that we do not we are not running into fraudulent practices, and we are looking at it in the backdrop of forensic accounting. So these are all things which have good intentions, which have been well done, and we have to actually look into the theoretical perspectives of how all these things actually evolved. Now, there was a time when we actually talked about accounting to be something which is just reporting, and by virtue of that reporting, you are telling the stakeholders how your funds have been actually used, or the purpose for which your funds have actually been used. But for to both in the inaugural as well as in the subsequent sessions, we saw that there have been massive frauds in cases where you said compliance of that the auditing actually took place with PricewaterhouseCoopers, and in spite of that, there has been some kind of fraud. That means you say that you have complied with the disclosure norms, you say that your statements have all done this, and in spite of that, there is some gap in terms of getting it implemented to the desired levels. So this is initially the basic purpose of looking into the whole thing, was to see at how far auditing does comply with that. If you look historically, if you look back at auditing, you'll again see the same kind of issue even there, because when you say auditing, the origin was in terms of certifying something to be true. Now, this is interesting. When subsequently we said we are not actually certifying it as true, we are saying it gives a true. It gives it, and we are still while certifying that what is said in the report is actually right. So this is the context in which we are trying to look at disclosure norms. So today, after voluntary adoption, we are moving into mandatory adoption of IFRS, integrating it with our Indian accounting standards, and we are now complying with INDES. Now, today, what I'm trying to do is only look at some of the inferential judgment part of it and see how effectively the same is being actually adopted. So with these few remarks, I'll just share my slide, and we'll try and discuss some of these pertinent issues which actually crop out from this basic fabric. I'm just sharing my slide. slide visible?
Yes, sir. The slide is visible. Can you please put it in slideshow mode, sir? Because it's very small now.
Oh, yeah. Just come now.
Yes, sir. Yes, yes.
Has it come?
Yeah, yes, it's visible, sir.
Okay. So we actually wanted to have a common language. That is why we actually looked into IFRS, because as we all know, if we are all coming from different nations with different languages and we try to converse, it's difficult to understand. So we need somebody to translate the same and to bring it into a common format. And that is why we actually wanted to have IFRS. We wanted to make it into a common language, which is understandable to all. And why this became necessary again? This became necessary again. Became necessary fundamentally because of to see the decision multinational corporations coming up at all. So when these nations established units across different nations, and so it is something I hello.
Sir. Now it's clear, sir.
Okay, so I'll continue. So we were discussing about the common language part of it. I think I'll do away with the video and we'll have the audio alone because we have some connectivity issues. The whole issue of common language came because we started opening up the boundaries of trade, movement of goods and service came out to be open. And we had a large number of multinational corporations which were establishing their units across different nations. So if each nation had a different kind of accounting standard, different kind of accounting period, different kind of materiality concepts, disclosure norms, it became difficult to understand. So the IFRS was a remedy to this in order to make it more comprehensible, to make it more, what do you call, put it in a uniform format, and then you have this as a common language. Another important thing on which we are actually deliberating in terms of different aspects, keeping each IFRS in place, is transparency, because all throughout there was an issue of how deep do we know from the financial statement? Is it speaking for itself? Is it revealing itself? Is it manifesting the true results in an organization? So those things came out to be of prime concern. And there we actually talked about how much of transparency we need to bring in. So disclosure norms, transparency norms became very important. We also talked about enhanced visibility. It means it must make itself something which is self-revealing, with lots of disclosure norms at different levels and at different points. There was also an advantage, a competitive advantage, because if you say that you are compliant with IFRS, we'll come to that a bit later. You have advantages in terms of sourcing funds, in terms of entering into foreign markets, even in terms of the profession. You have lots of advantage because you are competent enough to do the auditing, understand the reporting across the globe. If this was not there, perhaps each nation would have its own GAAP, generally accepted accounting principles, and they would go by their own or their respective practice norms. So, and then when you want to source money from a global market, you want to bring out ADRs, you want to become GDRs, then what you're submitting there as a justification for your requirement is your accounts, and these accounts might not be understandable to them. So then the comprehension issue comes up. So you have a competitive advantage if you say that we have IFRS, so everybody can understand the accounts, and you can go into a foreign market. You can source funds from different institutional financiers outside. Even when it comes to angel investing or crowd financing, your financial statements are something which becomes comprehensible to the stakeholders or prospective financiers. Yet another advantage that you have is accountability, because it talks about fixing the points at which the funds were sourced, the funds were actually utilized, and you're making it reveals the points at which accountability actually has to come. Now, this does not mean that yes, if 100% it is compliant in terms of disclosure, or 100% it's compliant in terms of accountability. I'm talking about what was actually the intention. And again, yet another intention was to promote efficiency. Contrary to just reporting facts, we are also making a very wise, judicious reporting of facts, wherein the purpose for which the funds have been used and the way in which it has been used is also revealing whether it was beneficially or efficiently used or not. And finally, the technology embedded practices which do come with your digital payments, with your digital transfers, with your IT integrated services. There is some room for that in your standards to accommodate the same. So these are some of the reasons why we actually went into IFRS. And if you want to sum this up, it is like entirely based on two important facets. One is the common language or the comprehension. Other is the disclosure and transparency in the operations, which were the major pillars which made us think of why we actually need to go into this. Of Convergence, I won't spend much time on this because these are things which I've taken from the website of. It's just a voting factor. Till we started talking about this long back, but from 1st April 2015, we said that there is going to be voluntary adoption, and from 1st April 2016 for companies which has a net worth up to this 500 crores, and then subsequently we went to lower levels and even unlisted companies. So by and large, we are talking about getting it getting it to move at a faster pace. So this that means by 2020 we are talking about getting this more integrated. And moreover, SEBI has brought out a circular which says that it's not just from 20 onwards, 5 preceding years also you have to give details and disclose details of financial statements for the 5 preceding years. So it has become like more revealing and more transparent in terms of the disclosure norms. Now, what are the benefits that we actually get from IFRS? The benefits are many in terms of the economy, in terms of investors, in terms of the industry, and the benefits to the accounting professionals themselves, whether when you act as your auditors or you act as finance controllers of these firms. Now we'll discuss each of this. As far as the economy is concerned, it provides a strong support for multinational corporations. That means international business essentially becomes possible, because otherwise, if in the absence of IFRS, it's difficult for firms to move across and set across their own units in different nations, because once they do that, you have to have your own accounting practices. And when they differ, it is very difficult to integrate. Moreover, in IFRS, we are also talking about integration in your accounts between the holding and the subsidiaries or branches. All kinds of that integration is possible, and integrative reporting is also possible. So IFRS made it easy for multinational corporations to locate themselves wherever they want or wherever they see an opportunity, and also to move swiftly in terms of their operations. As far as the accounting side of it is concerned, they had no problems because they were all complying with the same comprehensible, uniform set of standards. Comprehensible accounting language with uniformity, as we already said, this is something which everybody can understand across, and that gave an advantage in terms of their operations. Then benefits to the investors, which I just casually mentioned, there's a potential to tap foreign markets. We are talking about all kinds of foreign markets, not only for instruments, even for finance, because conventionally we used to talk about the theory of comparative advantage in terms of locating business units. So where do you actually locate it? Do we locate it at the place where the raw material is actually available in plenty? Or do we locate it at the place where the market is? Or do we locate it at a place where finance is available in plenty? Or at a place where manpower or the managerial skill is available? Now, the emerging business model talks about, yes, we do. It's not that we don't look at the advantage, but we find many of these resources that we want to be mobile, or it can move to the place where the opportunity does exist. Now, of which the most important was how do you actually get finance? So it is not always coming from the place where you are running your operations. It can come from, you can list your, or you can have your financial instruments from one country to another country. You can tap funds from another country. You can take institutional finance from another country where the cost of capital is cheaper. You also look into tax advantages and all that. But if you want to do this, that is more important. If you want to achieve this or do this, you need to be compliant with your IFRS, because if you do not have that, it is very difficult for you to actually raise money through ADRs or GDRs, or even to source institutional finance, because this becomes a prerequisite standard in terms of getting this money. Also, you have a wider accessibility in terms of all your operations. You become accessible to others, you make yourself accessible to others, and you have greater visibility in terms of your operations, because you say that we are one among the firms which comply with IFRS, and whatever we have said in our financial statements are things which all the stakeholders, whether you are a financier or whether you are a supplier, it can be very easily understood by the said parties in a format in which it is actually intended. So the benefits to the investors are that they can get money. Investors can reach out to the enterprise, and enterprise can reach out to the possible investors wherever they are, because they are IFRS compliant. Now, as far as the industry is concerned, you can expand your market. Because you can source more resources. Even in certain kinds of exports that you make, you are allowed to do that exports to those nations because you're complying with your IFRS. Now, it is not that this is the only requirement. Exports will require a lot of other mandatory statutory kind of conditions, but one among that will be what is your accounting system. So also when you're talking about mergers and acquisitions, when you want to fix the goodwill, when you want to fix the purchase consideration, these things turn out to be important. And when you are when you're having a competitive kind of trade, there also, because if you want to make a sell-off or if you want to make a combination, your competitive advantage will actually be there in terms of how you're complying with IFRS. The benefits to the accounting professional, this is very simple, easy to understand. You have enhanced professional practice, because earlier, if I have my proficiency and competences in one particular domain, then I remain in that domain and I can actually practice only with that particular domain. But now, because I'm IFRS compliant and we have the respective information technology acts in place in different nations, and you have all kinds of transfer of your auditing of financial statements digitally possible, your potential to practice, act as auditors goes beyond borders. That means because all nations are IFRS compliant, or all the nations in which we are looking for, or those nations in which we are looking for IFRS compliant, then in those nations, I can do the auditing, I can understand financial statements, and so my professional scope for me to go across is larger. And technology integration, because I might be sitting in one nation, but I might be getting my statements and audit reports from using the digital mode, and that is enabling us to integrate with this profession in a greater way. So that is also possible when we are actually talking about this kind of a balance that is happening over there. Now, accounting standards, and as I said, looking at this now, when we come to this, I'm only, because it's not possible for us within this short span to go through the whole thing. I'm talking about the relevance of disclosure in your accounting policies and what challenges actually emerge out of that. So when we are talking about disclosure of accounting policies followed in preparation as well as in the presenting of it, the most important thing is the purpose of the standard. And it is actually to promote a better understanding of the financial statement. But how much of this understanding was made possible is a question which still keeps popping up, because when you say that these statements have complied with certain norms and they were prepared accordingly, they were audited, they were certified to be true and fair, and subsequently you realize that certain things were not coming out in it, then you say, what was the purpose behind having this as a particular disclosure norm? Or it is even in that in the level of, why did we have this financial statement? Because we depended on, we actually placed our dependence on a financial statement, and we lost money. Investors would say that we lost money, or financiers will say that we are not getting back the money that we gave. That was already, I think, a number of such cases was referred to in terms of what happened with Satyam, what happened with great business tycoons winding up their business, going into liquidation, and then leaving the country. And then those who spent money and those who relied on the financial statements, they have lost. Now, the insolvency bankruptcy code is providing some, what do you call, interventions in terms of how you can get some relief on that. But basically, still this eludes us in terms of how the purpose of this financial statement is actually met. Or very simply, how much of financial, how exactly can you judge the financial position if you use a balance sheet? Or how exactly you come to know about the operating results if you look at a profit and loss account statement. So this has to happen in terms of what we actually discussed in the first slide, in terms of promoting accountability and promoting. But then when you look at standards, you'll see that this is not always happening at the levels at which it should have happened. Also, facilitates more meaningful comparison between financial statements of different enterprises, because what we can judge in terms of profitability, what we can judge in terms of solvency. You make a comparison between different enterprises, and these enterprises are also enterprises which comply or adopt the same accounting standards, and thereby they make themselves more revealing, and you turn out to have meaningful inferences based on that. Now, this is something which is known to all of us. We are saying that we are looking at the fundamental accounting assumptions of going concern, consistency, and accrual. But what does it actually mean? When we say going concern, we are talking about perpetuity. That means we are never foreseeing a liquidation. But again, as I said earlier, even when you said things are very good, things are very rosy, we are seeing a position where subsequently it suddenly went into liquidation. But the concept of the accounting assumption is that we have presumed that this will continuously move on. And with that continuity, we are preparing the statements. So disclosure is with that continuity. We are trying to disclose things with that continuity. We are trying to disclose, make comprehension with that continuity. So when we said comprehension, when we said disclosure, when we said accountability, all this must be there, integrated itself with the concept of going concern. So it must be in terms of how this concern is going to last, and we expect that it will continue to last irrespective of what happens to the owners, and that lasting impact is what actually forms a basic assumption. So also you have certain standards which you have set, and you keep it consistent for a relatively long period of time, or a relatively consistent period of time, and then that is where you're saying I'm not quickly, wherever you have a freedom to change your policy, that change must be something which does not affect the understanding that comes from the statement. If you say that I'm following a method of depreciation, or I'm following a method that is aligned with the taxation, how long you keep it consistent so that it becomes understandable. And finally, accrual. At what time are you recognizing revenue? At what time are you recognizing an expense to be an expense? So those are the time when we are going by the accrual concept. So under the system, the idea is to see that what relates to a particular period must come in that period. It must not be something which you say that it accrues at some other time. So when I want a judgment of profitability for a particular period, it should be actually relating to that period. So that is why we make all kinds of adjustments for prepaid and outstanding and all. So accrual is actually talking about what should have happened in a particular period. It should get its impact in that particular period. And this is very important when it comes to recognition of revenue in the accounting perspective. Now, areas in which we are actually talking about this, there are lots of areas in which I have not taken an exhaustive list. I'm just showing a brief of certain things where convergence aspects turns out to be more important. First and foremost would be, yes, depreciation, depletion, and amortizations. Basically, the decline in the value of assets. We call it depreciation or depletion or amortization based on the type of asset. So if it is fixed assets, you say it's depreciation. If it is a depleting asset like mines, you say depletion. And in the other one, when it is by passage of time, or like patents and all, you call it as amortization. So one is for wasting assets. Your amortization is for the intangible assets, and your depreciation is for the fixed assets. So what is the basic concept? One is it is likely to be affected by obsolescence. It is likely to get, that means depreciation happens because of obsolescence. It can happen because of wear and tear, whereas depletion happens only by extraction, and amortization happens only by passage of time. So that distinction actually comes out over there. As how do you declare? That means if I have an asset which is declining by extraction, if I don't use it for maybe 20 years, whether the value of that asset will decline. In the case of depreciation, even if you don't use it, perhaps wear and tear might not be there, but obsolescence might be there. So also in amortization, it is actually for the passage of time, because it's all held for specific time spans. So these things turn out to be relevant when you're making your accounting based on whether it is depreciation, depletion, or amortization. Similarly, your standards in terms of translation of foreign currency between foreign currencies, it becomes very important when you're integrating accounting with forex transactions, because conversion aspects get related over there. So also valuation of inventory, current price, market price, acquisition price, historical price, and what does it actually mean for each class of assets that you hold. Same with your treatment of goodwill. How are you going to value goodwill? On many occasions, goodwill gets actually valued in terms of negotiation. Negotiation in the sense that when there is a firm which is going into liquidation, or which is undertaking a sell-off, or it is engaging in a merger or a combination, the entity which is actually losing its presence, it is selling itself off, or it is trying to be an agent which is going out of the scene. It will talk about the entire value which it has created over a period of time. So they negotiate on the basis of that, in terms of who were our proprietors, who were our promoters, the market share that we enjoy, the profits that we have, the build-up in the past which we have done, the product that we have, the technology that we have, the managerial skill that we have. So on the basis of this, you negotiate for a value. And the other hand, the party who is going to acquire would say that on their side, they would have their own reasons to say that your market share has gone down, or your initial, the technology that you have is no more relevant, and they'll try to bring down the price. So ultimately, there would be a negotiation between the parties, and then you fix the value in that form. How do you account for this value that has been created? So also the valuation of investment. So here there has been lots and lots of innovative products in the financial market, and there are lots of investors who would like to enter into these markets with these innovative products. And how do you actually value these investments? The treatment of retirement benefits and recognition of profits for on long-term contracts. So these are some of the things which actually turns out to be areas in which each of this will make sense when it is looked into in the context of which it comes actually, it gets integrated into the financial statement. Now, what is important here, a major concern here, or a major consideration that is governing what we call the selection and application of accounting policies, which accounting policy is good, which accounting policy is bad. So this is the crux of what I would like to actually cover in terms of the presentation on Indus and IFRS. We have to look at these three important factors which we have conventionally been looking into, over which there have been lots of change over a period of time. Say, for instance, what are the policies which we can take as policies which are useful or beneficial to one enterprise, might not be so for another enterprise or another group of enterprise. So also what is good for one industry might have some a varying implication when it comes to another industry. So the essence of having these policies and integrating the same into standards actually comes from these three facts. One is what we talk about in terms of prudence. Prudence is you are recording for all the profits that you have actually earned, but you're not actually looking for you're not actually what we call recognizing profits before they are actually earned. But you can make provisions for the anticipated or would-be losses that can come. So this is prudence. That means you are always playing safe. But the way in which you play safe for different kinds of organizations, when you're in the service sector or in the manufacturing sector, again, when you're in a large-scale sector and a small-scale sector, is all different. So anticipation of profits and saying that this is what we're going to gain in future, which is not actually recognized. We are only recognizing profits which are actually earned, but we are becoming a bit conservative in terms of what we call looking for those things which would perhaps incur a loss for us. So we can make provisions for losses, provisions for bad debts, and so on and so forth. So this is what we actually talk about in terms of prudence. Again, materiality talks about ensuring proper recording or ensuring proper inclusion of material facts. Now, this is again true in terms of the big data that is coming up, the data analytics that is being taken up, because what is the data, what are the facts which are material, is again based on the nature of the enterprise, the kind of transactions, the funds involved, the stakeholders involved, and so on. So what is material is in terms of the kind of transaction and the implications which it actually makes in the business. It's as simple as that. Conventionally, when we all maybe years back when we started learning our accounting, if I pay cash and buy something, cash becomes material. The party from whom I have actually purchased or the party to whom I have sold becomes immaterial, because I record it as a cash transaction because I need not remember the party from whom I have purchased. But if I have purchased on credit, then in that case, I have a creditor to whom I have to subsequently pay. So also if I have sold on credit, I have a debtor who has to pay me in future. So then the cash part becomes immaterial and the debtor and creditor becomes material. Now this is the simple origin or the historical beginning of this particular perspective. But beyond this, there are lots of other issues in terms of the different transactions which are today taking place, where we say how the host of data actually becomes information and the information becomes knowledge. So this, your financial statement is actually, it has to be a repository of information rather than just being a depository for all data. That means when I'm saying what I mean by that, I don't know whether I'm making myself fully. What I mean by that is that you might be having lots of figures and a lot of data in your financial statement, but it might not be conveying the full meaning in the form in which it should actually do. So for instance, when I'm saying salary, if I say that I have 10,000 employees and I have 10 crores of salaries just with two figures, it might not be giving the full material details as to who are the people who are drawing salary about 10 lakh, who are the key men in the organization who are drawing 25 plus, and what is the salary which goes to the ordinary people, and what are going to be the repercussions if that key man in that organization leaves the organization. So you need a classified, you need a segmented kind of reporting for this one item called salary in order to make it more comprehensible. Same thing happens with many of your other items, even when we say stock, when you say inventories, when you say investments, when you say fixed assets, what class they belong to, and what are the unique features of those assets, and how when they are put in context they have a particular meaning. So materiality actually talks about this. That means what I'm trying to bring across through prudence and materiality is the same fact that your policy should be something that while reading the financial statement, it must be competent enough to give a wider, a deeper understanding into what does this mean beyond the data. So, all of us know the difference between data, information, and knowledge. So we are trying to see that it supports a decision. That means it is giving the stakeholder a competence to be knowledgeable in terms of taking a decision. Otherwise, it's just data which does not, that as I said, I only know that so much amount is spent on salary, this is the total fixed assets, or these are the total inventories, and I'm not able to judge what are the components and what are the intricacies behind acquisition, behind use, behind transfer. So that must be clear when we actually talk about materiality. Now, substance over form is actually talking about what we actually put in terms of colorful devices. We saw this happening in many, court cases in India. Substance over form is something like a disparity between letter and spirit. That means we might have complied with certain legal requirements, but the spirit of that legal requirement might not be met. That's why we call it a colorful device. Say, for example, when you are saying that there are certain, your financial statements are saying that we have uh, what we have achieved certain concessions, or we have achieved certain tax exemptions in terms of setting up certain units in backward areas, or in terms of having a startup of our own, or in terms of implementing certain guidelines of certain agencies, or in terms of translation of certain foreign currency, or in terms of swiping certain currencies to currency swaps. So all these things, when it is said, we are saying that we have complied with a particular law, but then it still stands defeating the spirit. Say, for instance, you say that you have established a unit in a backward area, and thereby you're talking about the concessions in the tax holiday which you're claiming. But when you look at a deeper levels into your financial statement, it was understood. This is a true case. It was understood that the actual amount of concession that you have drawn from your locational perspective is not what actually is due to you. That means you have accounted for the transactions which did not take place in the backward area by showing them as transactions which took place in a backward area. And you are saying that by letter we have maintained this. A unit which has a firm which is having a unit in a backward area, or something which you can call as a startup. I've got these tax concessions. You're taking those tax concessions, but the fact is that many of the transactions might not have taken place at that point of time, but still you're taking advantage. That means you're coloring up some of your transactions, and then you're saying that you have kept the law in letter. So here there must be some superiority or some priority for substance over the form. It should not be just that we have kept this. So for the sake of it, you meet certain conditions. And there is another case, say, for example, in a financial statement, you're talking about, suppose you want to show your liquidity position better, or you want to show your profitability position better. It can happen by doing certain things. So for example, if you just want to have a huge you want to have a huge gross profit, you can just produce when there is no demand. You can show current ratio to be very good in that form because your stock has piled up with you, but that is not coming out in the form of sales. That means you actually produced goods when there was no demand in order to show a better liquidity position using your current ratio, and thereby you are going to lose in future. So those things are actually there when you are, so similar to what you call inflating payments or deflating some of your income, or overstating some of these facts according to what you want to do. If you want to attract more financial assistance, you will show certain figures to be better on certain lines, and thereby you will be saying that we have not done anything against law. So substance is more important than form, or you have to see that you're complying with the substance of what it is actually meant for, rather than saying that you have abided by the law. So disclosure and your policies actually have to meet this prudence, this materiality, and this keeping the requirements of accounting and the standards in letter and spirit, not just in letter. So these are things which are important when it comes to the policy perspective. Now, your disclosure has to come in terms when you're presenting the financial statement, and also convergence and disclosure. When you're presenting the financial statement, it can happen in different forms. You say that certain things are there in the appendix, certain things are there in the footnotes. That is how it goes. So some aspects of that. I show my fixed assets, and I'm saying that a detailed description on historical is available in the appendix, or one other part is available in the footnote. So that is where we are saying, how are you presenting it? Then again, this does not turn out to be something which is comprehensible. And based on this, you have offer documents coming up when you have a new project or when you have a new field. Then the whole thing is not comprehensible because it is split into pieces, and it is not presented in the form in which it actually is made comprehensible to the parties for whom it is actually intended. That's why we are talking about convergence and disclosure, that everything related to something must be, it's not essentially that you put it in, you bring it into one kind of a consolidated form where I just read that, I understand the whole thing, rather than saying that it is one part is there here, another part is there, and you can read through all, only then you will have a fuller understanding. So convergence and disclosure becomes very, very important. Now, something very important in terms of not just the Indian accounting standards per se, but also in the use of the standards. It must support judgment on all these things, because how to judge, how to interpret, and how to infer is very, very important. And the way each person looks at a financial statement is quite different. Say, for example, if I'm an investor, I might be primarily interested only in profitability. If I am an employee, I might be interested in the liquidity part, whether I'm going to get my salary, or whether a bank might be interested in whether they'll be getting their principal amount and the interest back. So also the owners might be interested in the solvency. And by and large, the management is interested in productivity. And all these elements have their say in their own way in the financial statement, because there are issues pertaining to turnover. There are issues pertaining to pace at which this happens. There are issues relating to capital structure, which is dealing with solvency, your debt and equity, how much it is balanced. There are issues relating to the current assets and your current liabilities, which are actually dealing with liquidity. And there are obviously issues relating to your operating profit, the net profit, and the earnings before interest and taxes, and so on and so forth. So, but then how I actually project this in terms of the gap between associated variables. Say, for example, in profitability, gap between GP and NP. So also your debt equity. So these things will actually talk about the efficacy or the efficiency through which information is actually revealed in the financial statement. If judgment on these counts are not forthcoming, we talk about gaps or we talk about limitations in the accounting standards. So judgments that are required, the what do you call propensity to have the appropriate judgment indicates the success or the efficiency with which the financial statements and the financial accounting standards have been complied with. Now, all of us know that there is always something which is absolute and something which is relative in accounting, because these standards are trying to make things relative. Now, when I'm saying net profit, it could be absolute. But I am saying profitability ratio or net profit ratio, it is net profit in terms of sales. So it is relative. When I'm talking about net present value, it is absolute. But when I'm talking about profitability index, it becomes relative. So a relative judgment is what is actually attempted here. And it is this relative judgment which we are actually looking for when we are trying to judge how effective the financial statements have been in terms of the standards that have been prescribed for them. Now, this obviously creates a disruptiveness in your accounting system, which is very important as far as the accounting information and the use of accounting information is concerned. Now, what is the disruptiveness in accounting? One is the shift in focus, which partially we have already seen. Sorry. The shift in the focus has been from mere computation or recording computation and reporting to analyzing, interpreting, and judging. Once again, I'm repeating that. Conventionally, we always believed that accounting was what it was, just a chronological record of transactions. Transactions would take place, you journalize them, you post them, you put it into the ledger, you prepare your trial balance, and you prepare your financial statements. So it's just recording. And then after recording, there is initially recording in the journal, then there's some kind of a classification in the ledger, and then you're reporting the results. We made this much profit or loss, and we have this financial position. These are the assets, and these are the overheads. So that's it. That was the entire concept. Then when we started looking at this, we said this is something which is not giving anything in terms of it is just a post-mortem survey. So today we are saying it should be more in terms of analysis, interpretation, and judgment. That is what we were trying to discuss in the previous slide. There should be some competence in the information in the content of the accounting information, which helps us to judge these things. So it's more in terms of judgment, it is more in terms of inference, it is more in terms of analysis. That is why we are talking about integrated reporting, we are talking about comparative analysis, we are even looking into the intangible aspects of accounting, the intangible impacts of accounting. So the shift in focus, fundamentally the shift in focus is from recording, classifying and reporting to analysis, interpretation and judgment. And obviously the shift in skills is also on that line. Shift in skills. That means we trust that the stakeholders who use the accounting information through which is available in terms of the standards, accounting standards which have been created, to be shifting from just knowing or just understanding to having a knowledgeable use. That means they are in the pursuit of certain decisions, and they do have the skills to take that decision, and for that this should act as an input. The financial statements should as an input. It should act as an input which gives a solid base into how this can be actually used. And primarily, this is basically looking into a futuristic approach. That means that this is again, earlier it was like it's a postmortem survey. It's just telling you what has happened. It is not telling you what should happen in future or what is the kind of, even we are not saying always controlled, but we are saying it should support somebody in deciding what will be the next course of action from my side, rather than merely saying that it is something which has happened and this is how it has happened. I have this much expense, I have this much income, and I have earned this much. So I can go into the implications of each item and try to find out what actually has been the course or what actually has been the impact of those items in terms of looking into the aspects relating to that. Now, this talks about accounting research, which is very, very relevant. That accounting research or the contextual use of information with a sound knowledge is the end output which has to come from the financial statements. So here there are lots of issues. There are what you call tons of inferences which can emerge out of your financial statements. Say, for example, when we actually see a financial statement, it is broadly can be classified into 4 quadrants. Like you have your suppose I take a balance sheet, we might have source of funds which are long-term and short-term. And then you might have hundreds of items under each of this, which is long-term or which can come under the category of short-term. And on the other side, your application of funds, you will have your these funds of yours might go into short-term applications or long-term applications, and accordingly they might constitute fixed assets or current assets. Now, the matching between these is very important. That means whether your long-term funds have actually gone into purchase of long-term assets or fixed assets, and whether your short-term funds have been used for the purchase of current assets. And if there is a match in that, you say there's a perfect blend. But often we don't have that perfect blend, and there is a mismatch in the use of that. And when that mismatch is actually there, we are trying to build up a kind of reasons into why that has happened. So, for example, long-term funds which are going into the procurement of short-term assets, and short-term funds which are going into the procurement of long-term assets. Short-term funds will have to be repaid in the near future, but the assets to which they are committed are assets which are held for a long period. So, how much of this happens? What is the implication of fictitious assets in the balance sheet? It again indicates that a part of your capital has eroded off. What is the percentage of erosion that has taken place? And if that erosion is serious, is there an inclination towards sickness? So those, and how do you actually clean up your financial statements in terms of reduction in capital, some kind of an internal reconstruction, where you try to say that the market price or not the market price, the value of a particular, you're trying to bring down the capital base of the shareholders and use that amount to wipe off the fictitious assets So you're making some kind of a cleaning up of your financial statements. So that's also another one of the methods that you actually adopt to see how this integration actually happens. So there is substantial amount of research, or what you call thinking, which goes into this line to see how actually this can happen. So accounting standards are actually relating yourself into these aspects. Now, when we are actually trying to see the priority among these, when it comes to research, because research is actually trying to use this factual base for different purposes. I might be trying to look at red flags when I'm trying to look at forensic accounting. I might be trying to look at inventories when I'm looking at turnover part of it. I might be looking at the profit statements when I'm trying to look at the efficiency with which operations have happened. So on each of these aspects, I have to ponder deep into how much of this disclosure happens. Now, the disclosure that happens must tell us the relative risk, whether it is financial risk or business risk, that is involved in the commitment of funds. And there comes the concept of what we started off, becoming fair and becoming truthful in your statements. And that is what we are actually talking about. Now, this being said, I'm just concluding with these what you call remarks on what I was trying to put across. This being said, ultimately, what the investors would like to know is what is the chance of their being able to understand what exactly is happening inside this organization. Because these are all outsiders, they are all spread out, they're all from different parts. But then they are putting their investors have put their money into this, and they would like to know what has happened with that money, what was procured, what was used, how it was used, and that is the entire story which this financial statement has to unravel before. And how much of that happens is what is actually looked into. Now, this happens in a very this happens in what we call a very a kind of a diluted, or in a very a fashion in which the spirit is actually lost if the prudence is not actually maintained. And that is the place where we actually try to look at integration and consolidation which is happening. So accounting today has got so many things to do with innovative financial products, with the environment, with the climate, with the green energy, and with the human resources, along with the financials. And that is where your standards are getting revisited. But there are certain elements which become very predictably visible, and certain which are not in that form. So let me conclude. I'm not what do you call going into that, because as I said, I've just put a conceptual part into this. The idea is to see that the phases of convergence is what I actually talk, which all of us know. When we are trying to move into this, if we want to actually look at the discipline with its strengths, we have to ensure the extent to which transparency, the extent to which disclosure, and the extent to which integration actually has taken place. And if that has not happened, in spite of all that we have said in terms of accountability and transparency, if it has not happened, it will require revisiting. It will require, and this is something which is consistently and continuously happening. It is not something which gets standard. So if you look at each of the accounting standards, it talks about an aspect related. Suppose I'm talking about depreciation alone. Suppose I'm talking about revenue recognition. Suppose I'm talking about translation of foreign currency. In each of these aspects are actually coming out. Now, it requires a kind of research into how much of this is actually supporting disclosure. That means, is it that I'm just seeing from an outsider's perspective only one side of it? How deep I can see and how well I can look into it. Those are the things which are actually attempted when we are talking about the Indian accounting standards. In fact, when we want one set of standards with uniformity, there are problems in terms of not being able to customize it based on the requirements of each place, or based on the requirements at each point of time. So those things will obviously be there. But then in spite of that, we need to have a uniform set and a common language which is comprehensible to all. So thank you so much. Now, this is only a basic. With this basic attempt to look at disclosure, we need to come back into each of those standards, look at it with more specificity. I'm sure in the coming sessions, we will be looking at each aspect separately, like only fraud, distinction between errors and frauds, misrepresentation, manipulation. These are all things. What part of it is happening erroneously happening? What part of it is fraudulently happening? Is there a mechanism where your internal control systems are such that there will be no space for it? One of the methodologies that we can adopt for that is use of digital technology, because the technology itself will integrate what is happening and it will speak for itself. But then will that alone solve the problem? Can there still be things which are hidden? These are the questions which actually need to be addressed and answered. So thank you so much for this opportunity. I wish all of you the very best in your actual pursuits for higher learning in accounting. And also I would like to tell you that accounting profession is fast growing, and its growth has got two important dimensions, which I believe researchers and students need to understand. One is that it is very fast getting integrated with big data analytics. So there is a big technology part which is coming out to be very important there. Another, it is getting linked with mathematical modeling. When it comes to hard finance, it is getting linked with financial modeling. So when financial modeling, mathematical modeling, or mathematical models and technology is coming up, the kind of learning and research that we need to have has to go a bit wide. And with that depth, we can because the kind of data that is coming out and the kind of data that gets integrated into your statement, there should not be a gap there. When that gap is there, there will be still things which are hidden. So those issues must be taken care of when we try to look at accounting. And that is one of the challenge why we find people from different disciplines entering into accounting and turning out to be better than those who are functionally anchored into accounting. Maybe I'm a person in finance and I've been learning accounting for 15, 20 years. And I find somebody who was in some other discipline, just like our keynote speaker in the first session was talking about, somebody from physics will come and overtake us. Somebody from artificial intelligence will come and take over. There's a big danger for that, because artificial intelligence is also talking about the behavioral aspects getting integrated into it. So those challenges are